Hi there, welcome to PKFX, your Forex education hub. This is lesson 10, margin trading. In our previous lesson, we covered basic Forex terms, part 2. For more information, do check out our lesson 9. Now let's continue. We have learned that leverage and margin allows you to take large positions using small capital. This is indeed very beneficial to retail traders. As you start trading and when you set up your account, the broker will ask you to select the leverage value for your account. This is usually presented in the form of a ratio. So it is important that you know the leverage level that you are selecting. Leverage is the ratio of transaction size or position size to the actual cash or trading capital that is used for the margin. For example, 100 to 1 leverage means $1,000 of margin is needed to open a position size of $100,000. We call this a 1% margin requirement, meaning to say, using 100 to 1 leverage ratio, with a $100 margin, you can open position size of $10,000. With $10 margin, you can open position size of $1,000. Simple mathematics. Now let's throw in some numbers to get a clear picture on how all this works for you. Let's use Euro USD equals to 1.20000. Let's assume our speculation indicates that the euro is going to increase in its value. Therefore, we see Euro USD in buy mode. Recall that one standard lot size represents 100,000 units of currency. We open one standard lot, 100,000 units of Euro USD. This means buying euro with 1% margin requirement. Since Euro USD equals to 1.20000, we are buying 100,000 units of euro, which is worth 120,000 units of USD. Assume your trading account is in US dollars. Since the margin requirement was 1%, broker will automatically set aside 1,200 USD to open the trade. 120,000 units of USD times 1%. This is the power of Forex using margin. You are literally controlling 100,000 euros with just 1,200 USD. Now let's assume your speculation was correct. The price actually moved to 1.20500. You closed the trade and made a profit of 500 USD. Just like that. You gained 500 USD for such a small move on Euro USD. This is the power of leveraged trading. Still don't see how good of a deal it is? Let's put it in a different perspective. You had to set aside 1,200 USD as margin or deposit. You made a profit of 500 USD in this single trade. So your return of investment ROI for this trade was almost 42%. But the market is volatile. This kind of price movement can even happen within minutes, meaning you made 42% profit within minutes. That is huge. This is why the Forex market is definitely one of the best ways out there to grow financially. The returns are highly lucrative. But bear in mind, it can also work the other way around. What if your speculation was not right and the trade went the opposite direction? You would have lost 500 USD within minutes as well. That's a huge loss. This is why it is important to have a strong foundation in terms of Forex knowledge combined with money management. If you can handle it well, then leverage and margin can be your best friend. If you are not disciplined, it can be your worst enemy. When you close the trade, the margin that was used as deposit is returned back to your account and can be reused for future trades. Broker calculates the profits or losses and updates your account accordingly. This applies to all your trades. That concludes our lesson 10. Thank you for your time. Don't forget to like, share and subscribe to our channel for more videos. PKFX, this is your Take 5 into the Forex market. Your Take 5 to financial freedom. Good luck.